Alrighty, so this is the fourth video under the Maybe series, and it is the 12th under accounting. And in this video, we're going to be talking about how the issuance or repurchase of stock affects our three financial statements, right? So honestly, the easiest way to grasp this is just to start off on the financial statements. So we have our income statement, we have our balance sheet, and we have our cash flow statement, right? And I want you guys to think about something, right? Our income statement is sometimes called our P&L, right? So our profit and loss. It essentially is kind of the income or like the losses that that company has accrued over that period of time. And if you think about your personal income statement, you look at the money that you made from your job or your other sources of income, and then what kind of expenses that you had, right? As a business, does it make sense that if you buy shares of your own business back from other people, or if you issue more shares of that business to other new investors, does that affect our profit or our loss? That's not really something that affects our income, right? That might be like a cash item, right? We might have to spend cash or get cash, depending on whether we're repurchasing or issuing shares. But in reality, it doesn't really affect our income. So let's look at an example, right? Let's say that a company issues $100 worth of stock, right? Well, we know that an issuance of $100, that doesn't make sense that it would touch our income statement. That has nothing to do with our income. So there's going to be no changes there. So what do? We go from our income statement directly to our cash flow statement. And on our cash flow statement, all that really happened is that you issued shares out for the public to buy, and individuals bought those shares, right? So under our cash flow from financing, right, because this is a financing decision, you're going to have an additional $100 for issuing that stock, right? Now, that means that our overall cash increased by 100, right? So on our balance sheet, we're obviously going to see that additional cash. And then we know that whenever we issue shares, that's more money that's attributable to our shareholders, right? So when we issue shares out, that means that the pie in terms of our shareholders' equity got bigger, right? Because there's more money in that pie. So essentially, our shareholders' equity also goes up by 100. Right? So if we check our golden rule, assets equals liabilities plus shareholders' equity, we can see that our assets went up by 100 and our shareholders' equity went up by 100. Right? So really, kind of simple in that regard, right? We issued shares, we got $100 worth of cash, and that increased our cash balance, that increased our shareholders' equity, right? If you want to walk someone through it in like an interview setting, the way that I would go about it is saying that, oh, the issuance or repurchase of shares does not affect our income statement. However, on our cash flow statement, under cash flow from financing, we are going to have an additional $100. So our cash overall would have gone up by 100. So then we move on to our balance sheet. We're going to have $100 more of cash, and our shareholders' equity is going to increase by 100. And both our assets and our shareholders' equity went up an equal amount, so our balance sheet balances, right? So let's talk about the repurchase. So if you repurchase $100 worth of stock, right? So we have our income statement, we have our balance sheet, and we have our cash flow statement. Now, again, does this make sense that it would impact our income statement in any way? No, it doesn't, right? This is a financing decision. It's not it doesn't have to do with our profit and loss. So when we look at our cash flow statement, if we repurchased shares, right, meaning that we bought out someone else's interest in the business, what do we need to do in order to do that? We have to give them some amount of cash, right? So that means that this is actually a use of cash, right? Meaning that our cash goes down, right? If you guys remember, if our shareholders' equity decreases, our cash is going to decrease, right? So under cash flow from financing, we're going to see a minus 100, meaning that our overall cash went down by 100. That's going to obviously flow through to our balance sheet. So we're going to have, oops, I wrote it twice. We're going to have $100 less in cash, and our shareholders' equity, well, now we made the pie smaller, right? We bought out someone else's interest. So with that, our shareholders' equity is also going to decrease by 100. So let's check our golden rule. Our assets equals our liabilities plus our shareholders' equity. Well, we know that our assets went down by 100 and our shareholders' equity went down by 100. So both of those went down evenly. So in this case, the balance sheet balances, right? And I would walk someone through that the same way that you did for the issuance of stock. So this is a relatively easy one because it doesn't really impact the income statement, so there isn't much flow through all three of the financial statements. But it is something important and is something that you should be kind of privy to. So I hope that's been helpful.